Greetings, and welcome back to the podcast. This episode, we are joined by Mr. Jason Landau and Mr. Eugene Vath from Waratah Capital, a Toronto-based asset management firm that has grown from $25 million to approximately $4 billion under management since 2010. Mr. Landau is the managing director, portfolio manager, and head of the investment team, and received an honors business administration degree from the Richard Ivey School of Business at the University of Western Ontario. Mr. Vath is an investment analyst and holds a Bachelor of Commerce Degree from the University of Victoria, as well as a CFA designation. Among other things, we discuss capital allocation in the Canadian energy industry, considerations on growth versus investor returns. This podcast episode is powered by ATB Capital Markets. ATB Capital Markets provides financial solutions and strategic advisory services to help businesses thrive. With a track record of successful deal execution, ATB is a full-service investment dealer with a deep understanding and commitment to the industries it serves. Visit atbcapitalmarkets.com for more information. Good afternoon, Mr. Jason Landau and Mr. Eugene Vath.
Yes.
Thank you guys very much for doing this again.
Thanks for having us.
No problem. Today. So I thought for the purposes of today, we could structure the conversation as a back and forth between you guys.
Great.
And a reminder to the listener, maybe we'll start with Jason. What is Waratah Capital?
Yeah. Waratah Capital is a Toronto-based investment manager. We run about $4 billion in 6 different strategies. We're here to protect risk and mitigate drawdown. So if there's big sell-off in markets, we tend to greatly outperform and capture upside when markets are opportunistic. And really, we're go anywhere, can do anything in terms of equities in North America. We happen to be Canadian and like energy and have developed sort of a expertise for investing in it over the years. And we've been, I think, from the day one when the firm opened in 2010, we've been investors in Canadian energy.
The fund has been growing. When it started, it was about $35 million, and now we're at $4 billion, which is pretty good.
Yeah. Day one for me was $35 million. The founders launched with $25 million a couple months before I started, and today we're $4 billion.
Like I said, we'll structure the conversation as a back and forth today between you guys from Waratah Capital's perspective on a few questions on capital allocation within the energy sector as supporters of the Canadian energy sector. Just want to throw that out there. So
absolutely
big supporters.
Along with this podcast. So why is it important to separate the value of commercial and non-commercial production from the ethical considerations of a growing North American production? AK, it's good for the world to have North American productions. We produce it ethically and in good environmental standards, but why is it important that it's in a commercial frame of mind? AK, companies are making money.
There's 2 components, right? The ethical part we're entirely on board with. And if you think about, I'm embarrassed as a Canadian to say that a Montreal refinery purchases crude from a Middle East country that is wrong, right? But that doesn't mean from an economic perspective, a company on the other side of the country should degrade returns for the entire industry to offset that molecule. Now, on a commercial term, those Middle East countries, their break-even point is a lot lower than what a Canadian barrel is. So in some respects, they deserve to hit the market before that incremental barrel of Canadian production does.
Or at least on a budget adjusted basis, right? Like on just a pure production basis, those barrels would be far more cost effective. I think, the other sort of consideration is just a more practical one. Like, yes, I agree. We want more Canadian oil and gas globally, but at what price and at what economics? If you can't get your product to market at a reasonable price, then, the other sort of issues become secondary.
You got to make money.
Correct.
However, it's important to recognize the ethical contributions, however you want to phrase it, environmental, human rights of North American energy production.
Absolutely.
Nobody's beating that here.
No.
Yeah, the stat I always like to say to clients is Canada has the highest environmental regulations out of any oil and gas producing country in the world.
Right.
Like, fantastic. And think, whether or not you believe in sort of ESG, but sending Canadian gas off the West Coast Canada to displace coal-fired power generation in Asia is an incredible win from a global basis here. Is it carbon zero? No, but it's massively incrementally positive.
So what are the key factors driving Canadian energy companies to increase production? And how does this decision impact their free cash flow?
Yeah, well, and this might be a good point to go into the, one of the things that we noticed recently, BMO put out a note that kind of surveyed, and I don't have the number 51.
It was 59 oil and gas executives in Canada from both public and private players.
And asked them to rank their sort of corporate objectives. And from the Canadian producers, the number one goal was just to organically grow production. And that was 59% of all respondents. And from that context, there's nothing in there about economics or economic considerations. That's just a pure output decision. The number one goal of our organization is to increase output. And that sort of set off alarm bells for us when we look at the Dallas Fed did a similar survey amongst U.S. producers. The production growth wedge was the number 7 consideration. So that just sort of highlighted to us that there is a difference in mindset in Canada versus the U.S. that really, in particular here, that we see just a true focus on output expansion rather than a broader sort of economic portfolio of considerations.
That's been the mindset and strategy for decades. And it's ingrained in sort of nature, if you will, to grow BOEs. And I think it's changing. And I think it's changing, especially south of the border. I'd argue it's changed. And when the market requires that incremental barrel, the U.S. producers will provide it. But that mindset's not changed in Canada yet. Growing production, first of all, everything should be looked at on a per share basis. And there's 2 ways to grow production on a per share basis, your numerator and denominator. When the market only grows 1%, global demand, and supply grows 3%, doesn't sound like a drastic measure, but you can still drive higher production per share by shrinking your denominator and keeping your numerator constant, or just up 1%, commensurate with global demand.
There are companies out there that are pursuing a return of capital to investors. For example, Tourmaline plans to return approximately $3 to $4 billion to investors within the next 5 years. So it could be argued that there are companies going down that path.
Well, I think part of our argument would be that it's always the last call on capital, though. Obviously, we would agree that you want to maintain your base of production. There's this organic production growth is the number one objective, and whatever's left becomes the tail that, like, okay, we'll distribute out to you. We think that this different mindset focuses more on you could satisfy those returns first in a period of time when global oil demand or even, more localized gas demand is struggling. There's not necessarily a reason to grow production in advance of the return of capital to shareholders.
There's been a clear shift in mindset to return of capital, which is fantastic. But you also don't need to grow your output to the market. Companies today in this environment have the liberty of excess free cash. That doesn't mean that it's a 50-50 bucket, if you will, of splitting it. There's a universe where your production stays flat and you return a lot of dollars to shareholders via buybacks, and your production per share drives up really meaningfully. We recognize it's depleting resource and it's depleting production base. So spending capital just to maintain your production profile every year is mandatory. The question becomes, is the incremental spend to generate that new barrel of production worth it? And that is the ultimate sort of test, if you will, generating those incremental returns. We think the narrative and mind share or mindset has shifted south of the border, and that we hope gets adopted here in Canada, where I think we've been slow to adopt. And to expand on that a bit is the U.S. doesn't grow to the same degree that they used to. And there's been instances where they recognize that we contribute to the problem. The more barrels that hit the market, the worse price gets. And, think about what U.S. production has grown over the last sort of decade with the onset of shale. That same sort of discipline hasn't really been present in Canada. And if you think, the world grew 1 million barrels a day of demand for oil in 2024. Canada grew 150,000 barrels a day. Canada is 5% of global production, yet we were 15% of global growth. That feels like a disconnect from what we stand here today. If you want to grow production and sort of drive production higher, you can do so on a per share basis. And buying shares in the market today is incredibly opportunistic.
But yeah, and I think just to add to that, the other layer is that we are, egress constrained in Canada, and we are sort of at the tail end of the pipe. And so we not only have concerns or constraints around kind of global pricing, but also more regional constraints that end up impacting in-basin realizations. And in particular, like the entire basin will price off of the marginal molecule that clears that basin price, or that hub price, if you will. And so we think that, producers need to be conscious of the impact that their output will have on specific kind of pricing hubs or broader basin pricing. And having that secondary constraint should also be, at the forefront of capital allocation decisions.
If we were to use the analogy about pizza for the listener, that's one thing that's really made sense to me over the years. If we were to equate shares to pizza slices, for instance, when you reduce the amount of pizza slices in the pizza, there's less to share with other people. So why is it important to reduce share count in a company in the same manner? To give an example to the listener.
I would think of it differently. I'm struggling with the pizza analogy, just despite my love for pizza. If there are 10 owners in a business and the business is worth $100, if I start with 1 share and I bought 5 shares from you, I own 6. I own $60 worth of value in that business versus when I started with 10. And slowly, if I buy out all my remaining minority shareholders, that full $100 accretes just to me. And I get that entire cash flow stream. I get choice of how I allocate that cash flow stream. I get all the dividends related to that business.
Which is why it's important to, in a grand scheme like on the markets, to reduce share count for shareholders.
Yeah, and I think even one of the things that we've seen over the years is that the pool of capital that looks at the energy space has shrunk or maybe is staying flat. And one of the things we like to say is that even if that total pool of capital looking at the space remain consistent, the fewer number of shares within the space for that capital to allocate itself to inherently accretes the value of those that are remaining. And we see this in the US. We've joked over the years, we probably started out, looking at 50 companies or something like that on the US side. I'm just making up a round number, but that number today might be 20. And so the way in which we're even able to allocate capital to the space has fundamentally shifted, and more dollars are flowing to the residual of the companies that remain, and by and large, bidding up the value of that relative.
What catalyzed this conversation with you guys at Waratah? What made you start thinking about this? When did it all start to emerge?
It's probably been a couple of years, at least, I would say, that we've been really shifting our mindset. I think, obviously, coming out of COVID, there was sort of just a capital discipline that was forced upon the industry. I think in the US in particular, you saw a shareholder base that really pushed management teams to focus on capital allocation, capital discipline, and recognizing the impact of their output and what that had on global pricing. And so I think, like Jay was mentioning, that feels like they're further along in that adoption of that sort of a mindset, where it really is value, not volume. That is the principal consideration. And so one of the more recent examples, and I would encourage all your listeners to listen to the Diamondback Q3 conference call. They had some fantastic things to say on this subject. And really, they were just saying, the global market doesn't require our output right now. We see that. We learn from past mistakes, and we recognize that our output has consequences for price that lowers the value of the entire productive base of our business. And so in that context, until we see some sort of a signal, when we're in sort of more tumultuous times or have less visibility, it behooves us to really focus on our business, expanding our margins and reducing our share count, and thinking that that is the optimal capital allocation to be able to buy back shares, that you're essentially retiring on historical capital allocated rather than having a risk capital on a pro forma price outlook.
Is that strategy working for Diamondback?
Well, I mean, I would say yes. Like, look, it's always hard to disseminate this as having this impact. They did a transformational acquisition recently and the valuation improved materially on the back of that. But I think the view towards the company is biased more positive because of the capital discipline and restraint that they're showing on the output side. And so pro forma the acquisition, they committed to just sort of holding oil flat, and they see no reason to change that at any point in time in the foreseeable future. And therefore, price is going to move around inherently in a commodity. We understand that. But essentially, the number one call on capital above maintaining the productive base is to the shareholders.
From the perspective of a natural gas producer in Canada who views LNG as imminent, they might say that demand is rising. We need to fill the demand that's on the horizon. What would your response be to that?
But why? And that's my big thing. There is only one independent gas producer in Western Canada, okay, that contributes volumes, and that is an equity owner to that facility. And it's just ARC because it's 150 million a day they contracted out at AECO plus a de minimis handful. No other public company has volumes committed to that facility. Why? Because we have excess pipe capacity. Should that be filled? And that's the real challenge to us, is that the mindset has to change. Just because there's space doesn't mean you have to fill it. And what does it mean? If you fill it, price is terrible. And if you don't fill it, maybe price is a bit better. And not a bit, it is. And I'll tell you, the actions in Q3 this year, when AECO averaged the lowest price in history, AECO averaged 69 cents in Q3 of 2024. And in 2024, the full calendar year will average $1.38. And, going back to Q3 for a sec, only one of the top 5 producers shut in volume. And so you have a storage tank, which is in the ground, that's free. Store your molecule in the ground for as long as you like. You don't have to pay TransCanada anything, store the molecule. And when the time's right and the market demands your molecule, take it out. And is that because if you produced it in a 69 cent AECO environment, there isn't a company that makes money. So you have variable cash costs to cover. And I argue you have finding and development costs that have to be recouped over and above that. So there's no company in Canada that's doing 69 cent F&D plus cash OPEX. And arguably that molecule is only ever produced and sold once. So for you to sell at 69 cents and lose money on it, you have the opportunity to store it for free and sell it at a much higher price into the future. There's 5 producers in Canada on the gas side, represent 50% of the total output. We can affect change. And, I'm not asking for OPEC or, some have called it GPEC. This is no collusion environment. It's just make the right economical decision for your shareholders. Right now.
This podcast episode is sponsored by Conate Water Solutions. Do you need cost-effective water sourcing options to supply your next drilling or completions program? Conate Water Solutions is a specialized hydrogeology company focused on water well drilling, testing, and water management services in Western Canada and Texas. Contact info@conatewater.com or check out conatewater.com for more details. This episode is sponsored by 360 Engineering and Environmental Consulting. 360 is dedicated to shaping a better future by championing responsible development with a forward-thinking approach. As established leaders in the site closure market, 360 provides innovative solutions to address complex engineering and environmental challenges. From safeguarding communities to preserving our planet, 360 is committed to making a meaningful impact at every step. Discover the 360 vision and learn more at 360eec.com. One other argument might be it's a commodity and it's going to come back around eventually. So we need to keep production up from our own interests to keep it growing for when the commodity does come back. How would you apply to that?
Well, arguably, if you're doing everything on a pro forma basis, i.e. you're filling the pipe in advance of the thing, the big event having occurred, you will never see that good price actually be realized. And that goes back to what we were saying around price being essentially set by the marginal molecule that clears a specific price hub. And, so like Jay was saying, it's when you've got, and in particular with like mega projects where the timing's like a little bit suspect, you have ACO pricing at all-time lows in 2024 with production at all-time highs, which I guess goes without saying. If you've already essentially backfilled any expansion and egress that comes from that project, the global price might move around, but the inability to get the molecule to other price points or for the principal price point in Western Canada to be able to realize any of that, like the differential just basically acts as a shock absorber against any improvement in price elsewhere if the pipes are full on a consistent basis coming out of Canada.
Another argument would be that it's maybe a little Darwinian, where eventually the market will take care of itself, and whoever can produce the most for the longest, the last man standing sort of mentality is how that's the market. It'll take care of itself. We don't need any agreement on shutting in production or anything like that. How do you think about it from that perspective?
Gas was 69 cents in Q3. The market did take care of itself, and you had incredibly poor returns. In a world where gas is sub $2 or sub $1.50 for an entire calendar year, the returns generated on the capital to get there were poor. And investors, that company will not be awarded a multiple in the market, and the cost of capital will suffer. It's delivering high incremental returns on invested capital for every dollar you put on the ground. I'd argue storing that molecule underground for free for 3 years until price warrants it drives a much higher return on invested capital. And there's a direct correlation with return on invested capital and multiples or cost of capital a company receives. So it's not simply we have to grow at any cost just to show BOEs. And I think, at a large Canadian public company CEO said to me, I pitched him this, and he said, well, I think the investors will crucify me. I said, that's not the case anymore. He said, showing flat growth or even some sort of declining growth in one of your products because the market doesn't need that molecule is a positive outcome. And we saw it with the old Chesapeake, if you will, back in Q1. They announced they shut in 10% of their production and price went up by 10% instantly. The market rewarded proper behavior for, that capital. And we often think it's often overlooked. We find if a company spends dollars to bring on a new incremental barrel of production or a molecule of gas, it's often overlooked what the degradation in price does to the rest of the business.
Yeah. And sort of building on that. So one of the things we sort of looked at making just kind of a hypothetical company, if you will, like 100,000 BOE a day producer, and sort of flexed around individual wells, sort of IRRs, and looking at the broader corporate impact. And, there's a lot of assumptions that we don't need to run through all of them here. But in effect, we found that if you incorporated the price degradation of the growth output across the existing base of assets, and you charged that against the capital program, if you will, of the growth program, you only required a 1 to 2% on a BOE basis price degradation that would completely eliminate the economics of the growth capital that had been sort of deployed. And so you think back to in kind of the big shale ramp of like the late 2010s there in like 18, 19, companies were growing like crazy. Nobody was making any money. And the question was always like, why, everybody's drilling 100% IRR wells. Where's the money going? And there's some element of that that's like corporate costs, sort of 25 to 30% that just sort of shaves off the well level stuff. But the rest of it was actually coming from price and then higher declines. And the combination of those two things was essentially destroying all the economics that the well level economics were telling people, hey, if I assume 70 and 3 or whatever, make up your number, 80 and 3 through my production, the individual well economics tell me I should just keep drilling all day, but I'm not making any money at the corporate level. Why is that? And, so far as we can tell, that's like the principal degradation on price across the existing base of assets is largely responsible for that, in addition to some higher declines and impacts on service costs and things like that.
I was going to simplify that. The new BOE that's brought to market, if there's just simply a 1% reduction in the price for the whole business, that every BOE produced in that company sees a 1% lower price, it eliminates the entire IRR of the new wells. And that's the message, I think, and the mindset that I think is not communicated and not thought about properly of what the impact on price is to the rest of the business.
Low Canadian energy equity values to create an environment where sometimes it's cheaper to drill for oil on Bay Street rather than drilling new wells. Are you guys in favor of the correctly done acquisitions or not?
Yeah, absolutely. I think that's the number one sort of relief valve outside of organic growth. If you are looking to sort of grow the business, you think about an industry and a product that is largely mature. I think most people would agree to that, right? Particularly on the oil side, and gas markets are obviously expanding, but from an innovation perspective or anything like that, or a land grab perspective, most of the land's been captured. There isn't a ton of sort of broad new innovation that's driving hyper returns or something like that in the space. I think when you have a mature product in a mature market, M&A is the most logical next use on capital, and can be done highly accretively. If you're the, fourth largest producer in a basin, you're not necessarily doing anything new that is pushing the boundaries from a technical perspective. Like, you're just sort of doing the same thing as everybody else in the basin. You're never going to be able to grow yourself into relevance in that kind of a construct. And so our view is that there is a way for the acquirer co and the acquired company to both participate in economics and drive better upside, more capital discipline, larger company with more eyes from capital markets that is value accretive to both parties.
100%. Buy your barrels for cheaper in the market. And what have you done? May have taken out bad actors who just grow at all cost, and you've improved price. And, there's a large gas producer that's consolidating the last few years here, but I think some of that mindset is in place. Now, I think we have to strip out some of the growth barrels that are there in the market for gas, but by and large, consolidating down the numbers of players into a more consolidated industry should improve price over the long term. A very good friend in Calgary taught me something a long time ago is M&A has to make a business better, has to solve a problem. So I don't think M&A for the sake of doing M&A does anything. Whether or not you need more inventory in a specific area to run your plants more efficiently, that gets more volume through them, that can drive down costs or so forth. But that's solve a problem. So I'm not a proponent of just doing it for the sake of doing it, because I just like paying bankers' fees. So we're there. The one thing I want to say, though, is I think the U.S. players are going to come north of the border here pretty soon. And it makes entirely logical sense in my mind. Now, what I didn't anticipate is the government, hopefully former government, being as restrictive as they can, albeit this was only a year ago that we sat down. But yes, the hope is that a change in government here basically hangs a "we're open for business" sign on every Canadian lawn. And if I'm a U.S. player, I think, okay, my shale inventory is less than what it used to be. You tell me a foreign capital dollar that wants to invest in Canada today with this political situation. And I think if we, hopefully I'm going to knock on wood here that mid-May, there's a potential change in government. We hang a for open sign, if you will, on every border. And, the dollar goes 40% more in Canada than it does south of the border. And you've had a year or 2 years or 3 years of inventory degradation because you've drilled through it south of the border. We were for lunch with a former CEO, and he thought one of the big gas players in the U.S. would come north of the border to make a big splash. here. So I think that is the hope here. But in the meantime, it's clear that consolidation, whether it's the Montney or other players here in Canada, makes a ton of sense.
Do you think it'll help catalyze energy stock prices in the markets for their consolidation?
I think so. I think we've seen instances to date. I think when you saw Vintiv buy Paramount's assets here for a hefty price tag that sort of remarked, if you will, for a brief period of time, Montney values. Yeah, I think it's possible. The oil sands and oil is a bit different to me because it's how consolidated and how, domestic, if you want to call it that, it really is. There's really limited foreign players, but
yeah, I would say on balance too. I don't know that we necessarily notice the valuation discrepancy that I think a lot of folks here sort of feel exists. Our comp tables run across the border. I would say in general, like for like businesses trade actually at roughly fairly similar multiples. So it's not necessarily a Canadian Energies has this like wide discount on it. That said, there are some redeeming qualities that a U.S. producer might find in Canada, not the least of which is the currency, at least today in particular. The sort of improving valuations, I think the area where we've seen it the most is in those segments where people have shown the most discipline. And I think we've got a number of examples like we've really seen over the past year. Jay mentioned Chesapeake/Expand in terms of what they did and how they're viewing the market. And they've communicated rather openly to the market that they intend to be very restrained and disciplined in terms of their output, not necessarily producing to what is the, forecast capacity of LNG offtake in 2 years, but actually taking a sort of risked demand approach to that and sort of thinking more along those lines. Chevron recently with Q3 announced that they would be, and their capital budget, that they would be sort of slowing reinvestment materially, particularly in the Permian. And this was all going to lead to more returns to shareholders. And I think you saw the stock materially outperform on the back of that. So there are a number of examples where it's not necessarily like a Canada-US thing. We would argue that Canadian Natural trades at a very similar sort of valuation as a ConocoPhillips. So those are two companies that look generally the same and actually trade at relatively similar valuation. And the border isn't as much of an issue. I think the one perhaps exception being just the investor base. There are certainly US and foreign investors that won't come into Canada simply because the shares aren't part of their benchmark or, they don't want to have to deal with the foreign exchange risk and things like that.
Waratah might be considered an educated capital provider in a world where there aren't many capital providers to Canadian energy these days. Do you guys worry that your opinions are a little bit lonely in that fact that you do know a lot about the sector? Or is this sure?
No, I don't think so at all. I think the mindset's shifting. There was last year we were here around this time and
how many of there are you in Toronto?
In Toronto, yeah, it's a good question, but there's probably not more than
fewer.
Yeah. There's fewer for sure. But I think the end result that we're all trying to achieve is to deliver value to shareholders. And saturating a market with more molecules than what's needed that erodes price does not deliver returns. And we want those returns to show up. And I think at the end of the day, just like the analogy or pizza analogy or more of a business that you did before, Trevor, if you are a shareholder for the next 10 years of a business that keeps buying back stock, you are going to own way more of that business over time. So if the dividend dollars that flow out of that business, if there's a component that's a dividend, you will get more of it over that period of time. I don't think we're being offside or a different ask than most. It's just like what drives share prices is return on invested capital. And we want the greatest return on invested capital from the dollar that goes in the ground. And sometimes generating to get that highest rate of return, that dollar doesn't have to go in the ground.
Yeah, a generalist investor might not see it that way. They see the headline production growth metric, or is that is that true?
It's sort of hard to make that assessment. I would say that's not been our sort of experience. I think if you can show a detailed roadmap to value returns to shareholders, a generalist investor would be more interested in that than hey, we can grow production 10%. Like everybody can actually do that. You can just throw more capital in the ground and increase your output. So it's really, I actually would argue the opposite, that would actually bring more generalist eyeballs to the table, in that you would highlight sort of a disciplined capital allocation approach. And those folks would actually appreciate that and find the sector more investable, or perhaps even simply investable again.
Right. I would 100% agree. Like it is, I think it will attract new players and new investors from a wide variety of areas. I think the volatility, that we saw, I have a picture of my daughter. She was in 2020, she was 4, standing in front of my Bloomberg terminal. I think I happened to get the absolute low in oil of minus $38. And I said to her when she's 4 years old, said, you're going to remember this picture and you're going to show your grandkids that one day they're going to be paying $1,000 a barrel for this oil. And someone at one point in time, they had to pay someone to take away their product. And that volatility that we saw, I'll never forget that day when it was announced over the weekend that Saudi Arabia was sending every boat that they could, just before COVID really started. And the share price returns for that day will forever be ingrained in my head. I think Cenovus was down almost 50% that day in a single day. That does not drive generalist investor. It's sort of slow and steady returns that do it. And this is how we do it, is ensure and do whatever we can to ensure that volatility in price is minimized or can be minimized versus big ups and big downs.
One of the other things we would sort of highlight is I lived in Calgary for a number of years. I love this city. I love the people here. I love the mentality. And we do agree that there's fantastic resource depth here. One of the arguments that the industry will often put forward is we're going to be using these products for much longer than the current narrative sort of assumes that we're going to be doing. And arguably, if the second sort of line of thinking there is, well, the U.S. is short inventory, these other reservoirs are going to be depleting and we're going to have this. It's like, well, you could see a scenario where as you start moving out into that kind of a narrative, let's say U.S. production actually did roll over. I'm not sure that we agree with that particularly near term, but let's say you did start seeing that, then the value of those barrels becomes like hyper accretive and really valuable. And so if you can, in a time of a lot of sort of headline risk, we have new administration south of the border, we don't know what's going to happen here globally, a lot of conflict, total demand not growing all that much. We were surprised to see the extent to which there seemed to be just this pure focus on output growth rather than value, preserving the reserve. And if your sort of actions matched your words, if I told you you could sell something today for $1 5 years from now at $15, like that becomes sort of a no-brainer, right?
Also, there's hedging too, which comes into it. How do you think about that?
They're two entirely separate decisions. Okay. When AECO was 69 cents in Q3, you had an option to purchase that molecule, someone else's molecule that was selling for 69 cents to settle your hedge and not produce your volume. And you keep that in your back pocket for when prices are better. I just want to add one thing, but I think Eugene's going to have a comment on hedging here. But if you pushed out drilling your well or producing your well rather for a year out and you have a 10% discount rate on that cash flow stream, you only need a 3% uplift in price to make yourself whole. So if you believe that simplistic math here, you think price can be better in 5 years from now, and you don't drill that well for 5 years, you only need the math's not perfect here, but you only need a 15% increase in price on a BOE basis to make you whole. That's not that drastic if you're of the belief that the U.S. is short reserve life and Canada has this plentiful one and they'll be calling on our barrel for years to come.
Yeah, on hedging, I'm echo Jay's comments. Like they're really two separate decisions entirely, right? Like when you put on the hedge, you're protecting cash flows for the business, but you're not actually protecting that molecule. You can elect to produce it or not and keep the cash from the hedge. From our perspective, those are just completely disaggregated decisions. If you step back and think about just the resource in the ground and the value of the business, it's pretty fleeting to say that, well, I have a hedge on for this year, so I can move forward. And in particular, since you could collect on that without actually producing the molecule anyways.
This episode is brought to you by Upgrade Labs. Upgrade Labs offers a comprehensive range of cutting-edge performance and recovery services that have been proven to optimize your health in minutes, not hours. Whether it's accelerating muscle mass and bone density or addressing injury and inflammation, start your experience by booking a free cell health analysis at upgradelabs.com/Calgary. This podcast is brought to you by Energy United. Energy United is an organization with a mission to promote practical energy policy across Canada. Energy United is building a community of Canadians that are passionate about Canada's natural gas and oil industry and are willing to take action. Energy United is driving change on issues that matter, all the way from the carbon tax to the emissions cap. Join Energy United to make a difference at energyunited.ca. Politics. I don't know if you guys want to touch on change in federal leadership. Good.
I touched on it a bit, and my wife always snickers at me when I talk politics in front of my children. So I don't want to get too detailed here, but our office is in Midtown Toronto, and there was a by-election for MP seat. So the by-election, the Conservative member won, and he was actually our former trader at Morgan Stanley. So our relationship with them, so we know him quite well. But we think this was in the heart of sort of liberal country, if you want to call it, and there was a true change in seat and demeanor. So by and large, even if I think about, my friends won't listen to this podcast because they don't deal with oil and gas, but I would say a bunch of my friends probably voted Justin over the years, and I'm pretty certain that's not going to be the case come next election. So we are, as capital providers and Canadians, okay, I'm sort of excited for what the future brings, and we think about what the new government did in Argentina. Is very different from, what it is here, but we've effectively been closed for business for a decade, like on many different manners. And I saw recently a fantastic graph that showed foreign capital invested on a per capita basis. So they plotted Canada against the US. And from 2000 to 2016, it was line for line perfect, Canada and US. And in 2016, we stagnated and have since declined, while the U.S. has continued sort of at a 45-degree angle. So, if I think about the exodus of foreign capital, specifically from energy here, I get why. And if I think about what Kinder Morgan tried to build TMX, and it should have cost $6 billion, and it cost $36 billion. And we heard the stat that it was the 5th largest infrastructure project ever built in the world, and not largest from a scale perspective, largest from a dollar perspective. It's embarrassing. And if I was a foreign investor, not from a public markets investor, but I think about an entity, I wouldn't want to put $1 in this country either. So the prospects here are encouraging, and we're thinking a lot about how do we align our portfolios to better capture a change in government here in Canada. And we think it's going to be the resource sector. And, I know this is energy centric, but I do think uranium is sort of the greatest opportunity from a change in government. Canada's got the highest uranium resources or reserves in the world. It's a component we need for the future. China's tripling their nuclear reactors in the next decade. And the world's going to be undersupplied in the next 5 years. So those pounds have to come to market. We think the same holds true though for, resources as a whole. I think there's an opportunity for multiple expansion as there may be more capital coming here. And again, I don't think that capital is coming here to grow production, but I think it's a recognition of the resource that exists here and the willingness to potentially pay up for it, which is, we touched upon it earlier, but I do think the one differentiator of Canada relative to the US is resource depth in life. And that is worth something. Like if you did very simplistically, you build a DCF, and if my DCF goes on for 30 years or my DCF goes on for 10 years, that's a really different outcome for what the sum of that cash flow is and what my enterprise value is. And that to me is the big differentiator. And the hope is foreign capital comes back, because we're truly open for business.
I think obviously near term, there could be some speed wobbles, right? We have a new administration coming in the next week or so in the US. Some commentary there that's probably not very positive for Canada, particularly in the near term. But again, that could create the opportunity set for broader negotiations, maybe more sort of fiscally aligned governments or notionally aligned governments to kind of create this fortress North America type setup. So we'll see. We're sort of cautiously optimistic on what the future brings for Canada.
We appear to be headed towards a conservative majority, which could be 5 years long. It's not just a flash in the pan. Enough time to have some changes, hopefully.
I guess the one counterpoint would be that you'd have by then, I suppose maybe 3 years of overlap with like a guaranteed overlap with the U.S. administration, right? And so if you're thinking about pipes and some of those sorts of things, it's pretty challenging. I think a lot of the companies that have evaluated some of those cross-border things in the past would tell you it's going to take them longer than 3 years. Doesn't matter who's in power. And, to risk capital beyond that point becomes challenging for sure without that kind of longer term certainty. So I think bringing that back to the Canadian E&Ps, we do need to be cautiously optimistic that perhaps we can expand on egress with, a different administration on both sides of the border, but at the same time operate under the construct that we know that we are essentially short egress. And we need to really treat that egress with the respect that it deserves, because it has as much of an impact on financials and valuation as the quantum of output would have as well. And so in a P times Q business, you need to take care of both sides of that equation. And our focus is, if the output and the quantity is a little bit constrained for whatever reason, you might not agree with the fact that it should be. I happen to probably share your opinion. I'd love to see no egress constraints and sort of our ability to access the market fully dynamically. But that's not the reality. And so we need to operate within the constraints that imposes on the sector. And we have a window right now where there is some excess egress on the oil side, and we're about to enter that window on the gas side. And we just think it would be a shame that if within, sort of 12 to 24 months, we were back to the place that we were historically, looking at $20 oil differentials and AECO back to pricing $1.30 with super wide differentials, simply because we ran out and just filled the pipes immediately and didn't have anything behind that to kind of follow on.
Pipe capacity doesn't have to be filled just because it's available.
Also, not having to worry about obscure legislation from Ottawa with the Bill C-69 and all the other wacky things that are coming down the pipes. Maybe just a general sense that things are a little more rational.
Everything that we hear, the conservative leader is, he sort of gets it, right?
Yeah. And it matters.
It does.
Yep.
Look, I think what we've seen historically, even in various jurisdictions, Jay referenced Argentina, but like US, even under Trump 1.0, you can agree or disagree with his politics or policies or the way he goes about conducting his business. But just that notion of positive energy and just sort of like, feeling like you can do things, I think is a huge shift that is probably underappreciated. It just feels like, I'm certain this is true of most folks in Calgary, and I know we feel it in Toronto as well. It just feels like the weight of the world's coming down on you. And it just, that sort of shift in sentiment to sort of just feeling like if I do something, I can get it done, and there isn't going to be a million barriers in the way, and not just looking at it from a defeated perspective can have a huge sort of rising tide impact as well.
So do you guys have a large chunk of your portfolio in energy, or how do you think about that? How many?
Yeah, we're entirely opportunistic, and everyone always asks me, well, what's your allocation to different sectors? I don't even know what the percentage of the TSX that is certain industries. And it's just where we think there's an opportunity, we'll deploy capital, and we hedge a risk along the way. We will short a company to offset some of our long exposure. And that is just the same way that companies hedge their revenues, right? By hedging out the commodity risk. We're doing the same. We don't enter into commodity hedges, similar to a producer. It's shorting an equity to offset that. We would have a number of Canadian oil and gas names on the long side of our portfolio for sure. And I would say for the better part of 3 years, I think, coming out of COVID, we have I called it the RLI trade, which is Reserve Life Index. We used to trade a lot more and be really active and sort of turn over the portfolio. And I would say we've really cut down on that. It's just there's latent value and the market was slow to adopt it. I think they've gotten there, the market on recognition. There's still pockets where there's opportunities. And, say one of our big positions is ARC. I think it's just an undervalued asset relative to other peers in the marketplace. And we think they're doing things the right way. Go look at shut-ins, go look at the buyback as a meaningful call on capital here. So we're big fans of the strategic initiatives there. But yeah, we'll be firm supporters of Canadian oil and gas for a long time. And I truly hope many more LNG facilities are going to be built. I don't think they actually are, but I sure hope they are. Here's to wishful thinking. And it's kind of a shame we were so slow in the adoption curve. And right after our podcast last year, the opportunity to go see Corpus Christi in Cheniere's plant, Sabine Pass in Louisiana. And, the number one takeaway I came back with was I was embarrassed for Canada. And Sabine spent $25 billion building a facility on a MARF that slowly sinks into the ocean every year. And they went from 0 LNG to, I think we're 14 or 15 Bs today, going to 25 BCF a day in just over a decade. And, to think what LNG Canada sort of started out with, and we're going to be probably 10 years into it, and all we got is 1.8 Bs. Hopefully double in that. Did you have any?
Maybe if we're to leave the listener as we get towards the end, you guys, to leave investors or anyone listening with a comment, how would you sum up the discussion or any thoughts you want to leave with?
Yeah, I'll start. And I want to say, I encourage every management team and every board member who sits in that boardroom to think about their impact of what a new barrel that comes to market or new gas molecule does to price and how it degrades corporate returns. And I just think that's a powerful sort of narrative that's often overlooked. And it's incumbent upon executives and the board to think through that. And the free cash flow outcome can be that much greater to everybody if price doesn't erode and we're responsible with the capital that goes into the ground.
Awesome.
Couldn't say it better myself.
Well, I appreciate you guys' time. We'll wrap it up there.
Ron, thanks for having us.
Thanks for having us.
Hello, listeners out there. Thanks for checking out the podcast. Hopefully the episode provided some insights. If you enjoyed the show, check out trose.ca where more episodes are yet to come. You can also subscribe to the podcast where your token of support is much appreciated. Until next time, happy coffee drinking.